Evening, everyone. Welcome to tonight's virtual $1 trillion mixer here with Quest Trust Company. For those of you guys who don't know me, my name is Haley Gant. I am one of our certified IRA specialists here in our marketing department, and I work very closely with the rest of our marketing team to help to put on all of these events for you guys. I am really excited for tonight's webinar. I was actually kind of speaking with tonight's guest speaker before we got started to figure out what tonight he'll actually be talking about. And tonight, I'm really excited to have with us Mr. David Teo from Dallas, Texas, here to talk about investing into medical office spaces. David has done a bit of multifamily investing and has recently made the transition to really kind of focus in on the medical office building investing. So I'm really excited to see his presentation here tonight. But David, before we get started with you, I do just have a couple of quick announcements for you guys, kind of as we let everyone get signed on here, to let you know about what we have coming up here at Quest. And for those of you guys, if it's your first time joining us, first of all, welcome. This is just one of many of the events that we host here at Quest. And right now, everything is online, but we will be bringing back our in-person events. This August, our classrooms will officially be opening back up for Lunch and Learns in Austin, Dallas, and Houston every single week. So be sure to keep an eye out for that. But let me go ahead and get into tonight's quick announcements for you guys. Quick little commercial about Quest. At the core of our business, Quest Trust Company is a self-directed IRA custodian. So we basically act as the custodian over IRA accounts, and our clients use their IRAs to invest into non-traditional assets, things such as real estate, notes, or private placement investments. You can actually do all of these investments directly with your IRA account and potentially never pay taxes on the money that you earn and grow within that account. Now, we do hold about $2 billion in assets under management, and all of that is all privately held assets that our clients have self-directed their IRAs into. Really just kind of get that full diversification of your IRA and really explore all of those true investment options that you have. Guys, there's a lot of people that do this out there, but there's definitely not enough people that know about it. So at Quest, we are very passionate about not only teaching about self-directed IRAs and how they can be invested, but also bringing in different guest speakers from all different areas and expertises of the real estate industry. And although physically our offices are in Texas, we do operate in all 50 states. We have clients all across the US. So if you have questions, just let us know. We are more than happy to help. And I'll have our contact information here at the end of these few slides. Now, the very last bullet point on this slide here is probably the most important one. This is our disclaimer. Please be aware that at Quest, we do not give tax, legal, or investment advice. We provide a lot of education. We bring in a lot of different guest speakers, really just to provide the most relevant, best real estate education that we possibly can. But please be aware, guys, every investment comes with risk. Please make sure that you do not rush into investments. You take the time to make sure that you are working with professionals and making sure that your deals are really structured properly. Really cannot stress that enough, but please just always keep that in mind as you are investing. Now that that part is out of the way, I do have some announcements for some fun upcoming events that we have. Like I've been mentioning, we host a lot of events, a lot of educational webinars here at Quest. You can rewatch all of our classes on our YouTube channel. And we also have several kind of shorter pre-recorded classes and videos on our YouTube as well. Our YouTube channel has actually doubled in size in the last year. We are really close to hitting my next goal of 2,000 subscribers. So if you guys are on YouTube, if you use that as a resource, be sure to go subscribe to our YouTube channel. I do have Miss Sarah Shellum, also from our Dallas office, here moderating tonight's webinar. She is going to be sending some of these links to you guys. Be sure to check them out. We not only have our YouTube, we have an education center on our website as well. And we host a lot of webinars. We have tonight's event. We have a series that we host every Saturday called Self-Directed IRA Saturdays. And we also have a virtual networking happy hour. This is my personal favorite, probably because I host it myself twice a month, the first and third Wednesday. This is an online meeting. It's actually set up as a meeting through Zoom. So everyone who attends gets to share their cameras. Everyone gets a chance to introduce themselves to the group. And at every happy hour, we get anywhere from 45 to 70 investors joining us from all across the US. And it's really created a nice little ecosystem, great way to meet other investors. And I know, although the in-person events are coming back here pretty quickly up on the horizon, the virtual happy hour is great for meeting people that might not be local to your area. So even as the in-person events do come back, we will continue to host the virtual happy hour. So I hope to see you guys all there. And those are some really great events. Now, our big event that we have coming up for the summer will be our July Summer Intensive. This is a 3-day event. It'll be 3 Fridays in a row. It's half days, so it doesn't take up your entire day. It'll just be in the mornings. And for this event, we will be bringing out several different guest speakers and doing a deep dive into the different types of assets that you can hold in your IRA on each different day. So one day will be all about real estate, one day will be all about private placements, and the last day will be all about notes and private lending. And I will let you guys know, this is not going to be the basics bird's eye view type of event. All of our speakers have specifically been asked to bring a high level topic, case studies, due diligence, helpful technical topics that, from what they've been seeing in this past year here in the real estate market. So be sure to get your tickets to that. They're $25. It is a paid event because it is a bit of a larger production that we'll be hosting, but tickets are very cheap and you can watch the recordings if you can't catch it live. Last couple of announcements here. We do have a referral program. So if you guys are currently a client and you know someone else who could benefit from investing with a self-directed IRA, be sure to send them our way. Visit refer.questtrust.com or just call an IRA specialist and we can help you guys make sure that you each get your $25 credit when you refer any new clients to Quest. We also have a lot of great kind of announcements coming up in regards to our online client portal. Be sure to keep an eye out in the month of June. We're doing a really big push to educate our clients about all of the different features that our client portal has. You can upload investments directly to the portal. You can generate custom statements and reports. You can save them for later. And it's a really great resource if you are a Quest client and you have not been utilizing the online client portal. This is our message to you to go online, get logged in, explore the features that we have there. And it's a really great way to keep your account updated, secure, upload your documents. And if you have any questions about that, again, just let us know. So here at Quest, we really pride ourselves on being very easy to get a hold of. You can give us a call. You can email us at iraspecialist@questtrust.com. Or if you visit our website during our business hours, you can actually chat live with an IRA specialist. This is not a robot or anything like that. It's actually our IRA specialist. We're assigned different days of the week. So if you guys have questions and it's just a quick question, go to the website. You can chat live with us very easily there. And we are always happy to help. So without further ado, I'd like to go ahead and move right along into tonight's main presentation. Mr. David Teo joining us from Dallas, Texas. And David, I'm really excited about your presentation tonight. I actually think this is the first time that we will have brought someone out to specifically focus on the topics when it comes to investing into medical office buildings. So David, go ahead and take it away. Guys, if you have questions, send them to the Q&A box and we'll get them all answered at the end for you.
Thank you very much. Thank you, Haley. I suppose you can hear me loud and clear, right?
Yeah. Yes. Okay, your screen looks good. And we can hear you. Good to go.
Screen's good. Fantastic. Thank you so much. Thank you for that quick introduction. And well, good evening, everyone. My name is David Teo. As Haley said, I'm here tonight to give everybody a presentation on investing in healthcare real estate. Right? That's just another name for medical office buildings, right? So before we go into that, I'm going to give a quick introduction of myself, since, well, not everybody knows me. So I have been an honorary Texan since 1999. I've been here in state of Texas since 1999. I came here for school. I was originally from Singapore, came here to go to UT Austin, and have been here since, and very happy to be here since it's, well, I would say Texas might be one of the greatest states for real estate investing. In any case, currently I run a commercial real estate investment group And we have been in operation for about close to 4 years now, 3.5, 4 years. And in that short time frame, we have, within our network, we have acquired a portfolio of a little over $176 million in asset value, of which 34 million was raised through our investor members rather, and in my personal network as well. I have experience in various different asset classes. I started off in commercial real estate with multifamily, and then quickly diversify into medical office buildings, self-storage, land development, and a few others. I'm, sort of asset class agnostic, if you will. I think everybody should, right? We should all look at various different asset classes and put our money across the board to diversify it. Well, I came from a technology background. I spent a little over a decade in a tech firm. I was running product marketing strategy in that group, in the company. And after over a decade of being in that industry, I wanted a change. Was looking at various different things to get into. I dug into several different businesses, investigated on those, but eventually landed on real estate because, well, it seemed like the right place at the right time. And so I started doing residential infill development in the Austin area. And after a few years of doing that, decided that the way to scale my business would be to move into commercial real estate, right? So with that quick introduction, I would also like to kind of give a introduction of my business partners, the specific in the medical office space. They're not with us tonight, so I'll have a mention of them. So Dr. Paul Sink and Ryan Sink, father and son team, they're very experienced in the medical office space, right? So I bring a lot of experience on real estate from, and Dr. Paul Sink and Ryan Sink, as I mentioned, father and son team, they have a lot of experience in running healthcare businesses, right? So Paul is a retired physician and has been a physician, an ENT surgeon for, I think he mentioned several decades, 30 years, I think. And during the course of that, he ran a large hospital that's physician owned. So a group of physicians that, along with Paul, they own that hospital that they operate in. So they're very, very familiar with how healthcare businesses are run, right? So one of the key reasons why we decided to go into businesses together is, I bring the real estate portion and Paul brings the knowledge in healthcare business, so that when we go out and acquire medical office buildings, we have someone, namely Paul and Ryan, who are very familiar with the tenant's business. And you want to be very familiar with the tenant's business when you're buying a piece of real estate with a tenant that's signing 5, 10, 20 years lease with you, right? So anyway, so that's, the partnership, the team. Now, as Haley mentioned, I'm going to be talking significantly about the medical office space, right? I'm going to start off with talking about the market, right? Some numbers that show why that's going to be increasing, well, has been and going to be increasing demand for healthcare real estate, right? So if you look at this chart on your screen, right, specifically the part on the right, you would see that the number of people that are 65 years and older will increase by more than 30% over the next 10 years, right? So if you look from 2020 all the way to 2030, right? So over the next 10 years, that's going to be over 30% increase in the number of people 65 years or older, right? And then if you look to the left, right, the individuals who are 65 years or older have the largest number of office visits, right? Hospital or medical office visits. And so, what does that tell you? Well, that tells you that the demographic alone is going to drive increasing consumption of healthcare, right? And when healthcare services consumption is going to be increasing, well, healthcare providers are going to be increasing on the services that they provide, and therefore will need more space, right? And therefore will place more demand, right? There will be an increasing demand in healthcare real estate. And what happens when you have increasing demand for a certain type of real estate? Rent goes up, right? So rent goes up, what happens? Rent goes up, that drives increase in the income of those properties, of those assets, right? When income goes up, the value goes up, right? So as investors, we're always looking for assets that has factors that drive increasing value, right? So this is one of the most powerful drivers in driving value increase, right, in an asset as a result of the nature of the demographic that we're seeing right now. So so as you can see in the chart on the left, as I mentioned earlier, baby boomers visit physician's office on average close to 6 times a year, right? And one other piece of information is that between 2008 to 2018, clinical services spending outpaced hospital services spending, right? Growing by an annual average of about 6.3% compared to 5.1%, right? Basically, clinical services 6.3 increase versus 5.1 increase of hospital services, right? So what's the distinction between the two? Well, clinical services essentially is referring to services that are provided outside of a hospital setting, right? So later on, I'm going to go over, don't worry too much about this. Later on, I'm going to go over different types of medical office buildings. It ranges all the way from a hospital, the very large hospital complex, to a small-ish med-tail kind of facility, right? That's some of those that you find in a retail strip center, for example, right? So this statement will make a little more sense as I go over that. Okay, so now with the growth of the baby boomers, right, and healthcare spending, there is a need for the hospital systems, for healthcare providers to be closer to patients, right? So some of you might have already observed that there's, like in Texas, for example, right? There's Baylor, Scott and White, there's WellMed, there's Ascension, Seton in the central Texas area. These are regional hospital systems, right? And very frequently, you would see that they have facilities that are off of their hospital campus that are just kind of standing on their own, right? In a suburban area, right? So that is essentially, a model in which they're trying to get closer to the patients to make it more convenient, right, for the patients to access healthcare. Now, from a demand perspective, the projected demand growth in healthcare services consumption has been and will continue, right, to lead to some physician owners to consider sale and leaseback of physician-owned properties to fund their growth, right? So this is quite an emerging trend over the last year or so, right? We're seeing more and more of that, of physician-owned properties where they are liquidating the real estate. They're selling the real estate, not because they're going out of business, but they are selling the real estate to bring the cash, the capital necessary to expand operation, to essentially expand their business, to fund their growth, right? And they figured that, hey, why do we want to deal with real estate? We're doctors running healthcare business, healthcare service providers. Let's just focus on this. So we're seeing more and more of these physician-owned properties being put on sale, and with the owners or former owner then leasing the property back And that is a fantastic phenomenon for investors like us, right? When we're out there looking for properties, because not only are you able to buy a quality piece of real estate, but the tenant has proven track record in that space, right? Over the previous years of being there. So this is, as I mentioned, one of my favorite charts that basically speaks to the core of why I like healthcare real estate so much, right? It's a need-driven asset class, not a want-driven asset class, right? Everybody falls sick, but in addition to the fact that everybody falls sick, you have this demographic phenomenon that's going to drive further demand, right, for healthcare services. So I'm going to take a couple minutes to kind of go over several different types of medical office buildings, right? And I'm kind of going to go from the largest to the smallest, okay? So on the larger side, you have those health systems, medical office buildings, right? The hospitals, the medical centers, they're usually large with multiple buildings. Typically they have Class A features, right? And there is, what's the word I'm looking for? There is a inherent value to this type of assets. Why? Because this type of properties are usually close to the city core. And there is only so much infill land, on the hospital campus or within that city core, or even adjacent to the campus, right? That these parcels become very unique, very differentiated, and that they hold their value in the very long term. And as the city continues, or the market that they're in continues to grow, their inherent value continues to go up, right? So one other thing that I want to mention about this health systems is, this type of larger scale hospital buildings is that now. So when it comes to reimbursements for the doctors, right? The doctors, performing services and getting reimbursements for their services, right? Excuse me, because of the fact that they're getting lower reimbursements for their procedures and basic services compared to in the past, they are more driven to expand their footprint, to expand their reach. To increase basically the customer base, right, the patient base, right? And so getting services out to where the patients live through their satellite, medical office buildings becomes increasingly crucial in order to capture these additional markets, right? To capture these patients into their systems so that they can then, funnel the high acuity procedures back to their hospital, back to their hospitals, right? So that they can refer these patients who need more involved procedures back to the hospitals. So it's sort of like a hub and spoke kind of model, right? So, and one other thing is that, and this is something that, I wasn't aware of until I got involved in this asset class and had conversations with industry experts who are very familiar with how the healthcare business works. People like Dr. Paul Sink. The doctors get better reimbursements for the same procedures if they do them in an out-of-hospital facility. These are called the hospital outpatient departments. That is still either on the hospital campus or adjacent to the hospital campus, right? So they get better reimbursements for the same type of procedures if they do them in this type of HOPDs, right? Hospital outpatient departments, than doing the same procedures at an off-campus facility that is, further out, right? So, and generally this HOPDs, hospital outpatient departments, are more convenient for the patient since they don't have to be inside the hospital and go through the inconvenience of being in such a hard to maneuver hospital environment, right? And at the same time, the doctors practicing in such HOPDs, they can still charge full hospital rates, right? So from a real estate perspective, we are looking also for opportunities adjacent to a hospital system in which to attract doctor tenants, right? Healthcare tenants, where they can be part of this hospital outpatient departments of the hospital system. So the next type of medical office building is ASCs, right? Ambulatory surgical centers. In a nutshell, are healthcare facilities which offer patients the opportunity to have certain types of procedures performed outside the hospital setting, right? So they are, I guess, kind of like a hospital, but not at the same level of a hospital in the kind of procedures that they offer. So if you would like to kind of think of it from a hierarchical perspective, they're one step away from being a full-blown hospital. And then the next type of medical office building is the life sciences or academic medical office buildings, right? So these are kind of like your typical medical office buildings, but there is some distinction. This type of buildings are generally tied to some NIH funding, right? National Institute of Health funding. So this government funding will certainly is expected to increase with the Democrat administration. So and also the need to, well, in today's environment, right, with the pandemic last year, the need to stay on top of virus research. And so going forward, we certainly expect more life sciences research-based type of asset types to continue to be in demand, or increasing in demand rather. So this type of buildings generally, they can have both the research lab in there, as well as medical office clinics within them, right? So this particular example is, in fact, Paul, my business partner, is one of he's a partner in one of he's a partner in this building, and this is one of their portfolio in their partnership in a partnership that he's involved in. And so in this particular building, there is the dermatological lab in there, as well as clinic spaces where they see patients in there as well. So a lot of this type of buildings are on campus, right, on hospital campuses, but there are also independent research labs off campus. One example is what you see on the screen, right? This building up in Dallas. And then next we have the, your typical off-campus medical office buildings, right? So these are medical providers that, need to be closer to the general population and providing more convenience, more accessible care. Typically, they are tenanted by your PCPs, right? Your generalists, dentists, chiropractors, some labs, podiatrists, physical therapists, urgent care, dialysis, and some medical franchises, right? So I think this is one of the ones that most of us are most familiar with, where you have a building that houses a variety of different providers, right? And most of this buildings have a triple net lease, and I'll go over that in case some of you might not be very familiar with the term triple net lease. So most of this have triple net lease. They have plenty of parking, good signage, and most of this are independent. They're not part of any hospital system. And then we have standalone medical office buildings, right? So the distinction between the previous one and this one is this type of building generally is a single tenant building, or they have only maybe 2 or at most 3 tenants in the building. And there is one tenant that sort of dominates the entire building in the sense that they take up majority of the space, right? So the most common ones that you'll see will be those standalone emergency rooms, urgent care kind of facilities, right? Dialysis centers as well. You'll see some of those, right? And typically these are physician owns. They are usually owned by doctors that first started a one location, and then they expanded as they continue to grow their business, their patient base, right? So very typically physician owned. And then finally, MedTail, right? MedTail, well, as you might guess, it's a medical retail office buildings, right? So medical retail, you can see from the picture, it's essentially a healthcare service provider situated in sort of a shopping mall or a retail strip center area, right? And having a property in a retail shopping center can create a synergy, right, with the neighboring tenants, right? Having a restaurants or grocery stores or a pharmacy or or maybe like a post office, it can attract extra patients from people just going by doing the business. Oh, there's a doctor here, or there's a dentist here, or there's a physical therapist here. And that could just drive awareness, more eyeballs, right, on where they are. So many patients find added convenience in being able to frequent the neighboring retailers and businesses while going to see their doctor or get their treatment done, right? And for this type of properties, they are usually developed with high traffic flow, ease of parking, that makes it easy for the patients to access, right? So, typically you'll find some urgent care facilities in there, some dentists, dialysis facilities, physical therapy, dermatology, and things like that, right? So this is another type of medical, or rather MedTail office buildings. Generally, in a MedTail office buildings, as I mentioned earlier, it's sort of in the shopping center, but usually, you would have several medical type tenants in the same facility as well. Generally, not all the time. Sometimes you just find one, but a lot of times you have several different types of medical tenants that again will drive that the synergy, right? Because somebody goes to see a doctor, and they realize that, oh, there's a dentist, a few doors down, or there's a dermatology a few doors down. Obviously, to a large part, people don't make doctor choices decisions on just running into a facility. It's highly driven by insurance, right? Whether their insurance coverage covers whether they're in their network or not out of network. Having said that, though, the additional eyeballs it provides if they're in such a setting would drive oh, okay, yeah, let me go check to see if this facility is actually within my insurance network or not, right? Medical office building, how does it work? So one of the things, guys, if for some reason my audio comes out choppy, please do let me know. I have just received a notification from Zoom that says my internet is a little unstable. But do let me know if it's getting not so good, and I can always repeat what I say. Okay.
Thanks, it glitched for a second, but other than that, you're good. But if it cuts out, I'll let you know.
Fantastic. Thank you. So guys, the first thing I want to kind of go over is triple net lease, because that's one of the greatest value of, that's one of the key values, right, of investing in medical office building, the triple net lease, right? Or in some cases, you will find absolute net lease as well, right? So let me talk a little bit about triple net lease, because not everybody may be familiar with that term. So, obviously when we rent something, there's always a lease, right? And there's always a rental rate, and that's sort of the basics, right? Like, the most basic model is perhaps renting a single family home, right? You go rent a house. On the lease, it will state the start date and end date, usually a year for renting a house, right? And usually, and it will state how much the rent is going to be. And obviously there's a lot of legal terms in there, but other than that, that's pretty much it, right? As a tenant, the tenant pays the rent every month, and the lease is for a year. The year is up. They either renew the lease or they don't, right? And they leave, right? So, and then, if anything breaks, well, they'll just pick up the phone and call the landlord or call the property manager. Hey, the AC, and the landlord is responsible for paying for the repair of the AC or replacement. In a triple net lease, it's not like that. It's different in the sense that a lot of the operating expenses incurred by the property. In other words, as a landlord, well, you will actually not have to pay a whole lot of stuff at all, operating expenses wise, right? So let me give you an example, right, of what's included in the triple net. Okay, well, let me go over the triple net first, and I'll give you some examples. Okay, so the first net, right, triple net or net, or three N's, right? Triple net, that's why it's called triple net. The first net is the property tax, okay? The second net is the insurance, right? Insurance for the building, liability insurance, and so on, right? And then the third net is what is called a common area maintenance, right, or CAM. So these three nets are paid by the tenants, right? So in a building where there's only one tenant, well, that tenant pays for all the property tax, all the insurance necessary to insure the building, and all the common area maintenance, right? Now, what is common area maintenance, right? What's included in the common area maintenance? So generally, common area maintenance refers to the expense of maintaining the common areas in the building, right? So that could include if there is an elevator, then you'll be maintaining the elevator, maintaining the lobby, the public bathrooms, and so on, right? So those are all generally considered common area maintenance, right? One thing I would caution everyone is that maintenance, right? Always look into the lease, right? When for investors, when we buy a property, when we analyze a property, whether it's a good deal, a bad deal, or okay deal, one of the first things that we look at, well, first, obviously, asking price, the rent, and so on, right? Once we get past that stage, one of the first things that we look at is we dig into the leases, right, with each tenant to understand what is included in this triple net, what is included in this common area maintenance, because we can never assume that it's always the same things that are included, because sometimes some things that are included, a tenant has higher negotiating power and therefore negotiated that item out of common area maintenance, right? So always need to look into the lease to understand what is included in the common area maintenance, right? So as I mentioned earlier, if this is a building that has one tenant, then that tenant pays for all of this: tax, insurance, common area maintenance, right? If this is a building that has three tenants, then it will be divided up into the proportion into proportion for each of the tenants. Okay, and the proportion is determined by how much space they occupy, right? So if there's 10,000 square feet total, and then you have one tenant occupying 8,000 square feet, and then another tenant occupying 10, and another tenant occupying 10. So then the tenant that occupies 8,000 square feet is going to pay 80% of the property tax, 80% of the insurance, 80% of the common area maintenance. And the other two will pay 10 each, right? What if there's a vacancy, right? What if, say, you have your 8,000 square feet being rented out, you have your 1,000 square feet being rented out, and then you have the other 1,000 square feet being vacant. Well, that's when the landlord will be responsible for paying that 10% share of the property tax, insurance, common area maintenance, right? So in other words, if all goes well, if it's 100% occupied, the landlord pays none of the property tax, none of the insurance, and none of the common area maintenance. But if there's a vacancy, the landlord is responsible for that vacancy's proportion of this triple net. One other thing that I want to mention is that generally common area maintenance, generally not all the time, okay. One easy way to kind of consider it is repair versus replacement, right? So usually, if it's repair, then it's the tenant's responsibility. Usually, if it's replacement, then it's the landlord's responsibility. If the AC needs repair, then tenant's responsibility. If the AC needs replacement, landlord's responsibility. But that's not always the case, right? As I mentioned earlier, you need to look into the lease to know exactly what's been agreed upon between the tenants and the landlord, right? There are, it's not uncommon, for example, for either a retail strip center or a medical office building in this case, right? For the tenant to be fully responsible for the HVAC. In other words, if it fails and needs to be replaced, they are responsible for replacing the replacement costs of the HVAC system. It's not uncommon. But again, you can't assume that's the case. You got to look into the lease, okay? So that's the triple net, right? I kind of went over this without showing this points on my slide. My apologies. One thing that I want to point out, for those of you who might be thinking, oh, you know what, I've cash in my self-directed IRA account, and you're considering, buying a building like this, which is great. Another model is, well, you can act as a passive investor with groups that are actually purchasing assets like this, and you can participate on a passive manner, right, without having to actively manage this asset. Now, if you do buy your own asset, right, one thing that you want to be very mindful of, right, is that looking at the lease, when do they expire, right? Because one thing that gets some new investors when they look at the deal is that, oh, they work out the numbers and the numbers look great, cash flow is great, return is great, but then they forgot that, hey, 3 years later, the lease with this tenant is going to expire. 4 years later, the lease with that other tenant is going to expire. And they say, okay, well, yeah, okay, I know it's going to expire. I'm going to, either extend, renew with them, or if they don't renew, I have to bring in new people, right? If you bring in new tenant, you got to factor in the commission for the leasing broker, right? And the commission for the leasing broker can be very substantial, usually very substantial, right? Because the commission to the broker is a percentage of the total lease value. And for this type of assets, we're talking about minimum 5 years, right? Sometimes you'll find 3 years leases, but not very common. Usually minimum 5 years, sometimes 10 years, sometimes 20 years, right? So you would have a percentage of this full 5 years, 10 years, or even 20-year lease value, right? And generally for the longer time frame, they kind of chop it up. They have a progressive scale where it's, for example, 5% for the first 5 years, 3% for the next 5 years, if they were to take up the option to renew for the next 5 years, and so on, right? So bear in mind that these are usually paid up front, Okay, so when you hire a broker to find a tenant to fill up that vacant space, the 6% or 5% for the next 5 years, it's paid upfront at that moment once they find you a tenant, right? Now it can be negotiated. You can obviously negotiate to pay it over time, but generally it's paid at the point where the lease is signed. So why invest in medical office assets, right? So earlier I showed you those charts. The numbers don't lie. The demographic of this nation is driving increasing demand for healthcare services, right? And this is not something that happened, a few years ago, or even, a few tens of years ago. This is, all the way back, to after World War II, right? Where the country developed in a certain way, the population developed in a certain way that now we have an increasing growth in the number of people who are needing the most healthcare services, right? So when demand for healthcare services go up, well, demand for healthcare real estate go up, right? And therefore that will drive rent increase, and therefore that's going to drive value increase, right, in this assets, right? And looking at the near term, right, a Democrat government in office is going to drive funding for consumer healthcare. And when you have more money going into funding consumer healthcare, it's going to drive consumption, which drives the service provider to expand their businesses, which then drives demand, which is what I just said earlier, right? I know I keep flogging this dead horse, but I love to keep flogging this dead horse because it just kind of, drives home the point that this particular asset class is prime, not because of the sudden phase of the economy, but because of the nature of the services that the tenants provide, and the nature of the country's demographics is going to drive increasing, substantial increasing demand, right? This is an asset class that is almost pandemic proof and almost recession proof. I don't think there's anything that is absolutely recession proof or pandemic proof. But if you want to pick on something that is proof, either recession or pandemic, this is as close you can get to it, right? At any point in time, anybody, people fall sick, they're going to need healthcare, right? I haven't clicked on the Q&A because I can't click on it when I'm presenting, but I'm sure somebody has asked the question of telemedicine, right? Telemedicine or telehealth, would that not drive decrease in demand for healthcare real estate, right? And the answer is no. In fact, based on studies that was done, or observations that was done over the course of last year, it was very insignificant. And so there is still a very significant portion of services that cannot be done online, right? So which brings us to as an investor, we don't just say, hey, medical office building, we're going to machine gun it. Anything that comes our way, we're going to buy it, right? No, there's got to be a method to it, right? How do we mitigate risk? How do we minimize risk? Even in a lower risk asset class like this, how do we further control risk to ensure that we have a much greater chance of outsized return, right? And so one of the ways is identifying potential threats, right? Telehealth is certainly a potential threat. So then, in the assets that we focus on, that we look at, we are focusing on properties that are suitable and that provide services that cannot be easily replaced by telehealth, right? So the Leases Center is one of them, and those that requires in-person procedures, testing, that's not something that you can do over the internet, right? So focusing on assets that has such tenants is one of the key strategy we adopt. Stable income from stable tenants, right? Healthcare providers, business, generally they don't go up and down with the economy, right? Again, in a recession, people still fall sick. I would argue that perhaps in a recession, more people fall sick because of stress and what, all other kinds of reasons, right? So very stable income from very stable tenants, right? Generally long-term leases. One of the things that I love most about medical office buildings, and there are other asset classes that kind of share similar characteristic, is you don't need to guess what the rent increase is going to be 3 years from now, 5 years from now, 10 years from now. It's built into the lease, right? The rent increase is built into the lease, right? So, for residential-based assets, right? Like, single family homes or apartments, multifamily, right? There is no built-in rent escalators, right? So as an investor, we have to project, right? What is the rent increase, rent growth every year? 2%, 3%, 5%, 7%, right? And it's a combination of science and art, right? To be able to project, accurately, right? So medical office buildings take, this one variable out of the picture, right? So you don't need to, in fact, you don't need to project. It's written in the lease that it's going to be a 2%, 3%, 5% rent escalator every year, right? So that's in the lease, right? So every year it will automatically increase by 2%, 3%, or 5%, however much increase is being negotiated with the tenant. So that's one of the things that I like about medical office assets, because it's very clear. One less thing you have to guesstimate, right, or project, which means one less thing to get wrong, right? And one less thing to get wrong is, one step closer to achieving projected outcome or outperforming projected outcome, right? One other thing is that the leases that are signed with the tenants are usually personally guaranteed by the healthcare providers, right? So in the assets that we buy, we always insist to have the tenants sign a personal guarantee, right? And who are the tenants? Well, the tenants are usually physicians, right? They're usually healthcare providers. And these are usually high net worth individuals. So their personal guarantee actually means something, right? Actually has substance to it. So that's the other point about that, right? Stable and consistent return, right? Stable return, as I mentioned already, right? The tenants are stable, and the return is consistent, right? And it's consistent. Why? Because you have the rent escalator built in. You know exactly what rent's going to be 2 years from now, 3 years from now, 5 years from now, 10 years from now, right? So that's one of the other thing that allows us to be very comfortable about projecting performance. So finally, I'm down to my last slide. I know I've gone a little long. So what is a typical deal model, right? Now, so when I talk about typical deal model, I'm talking about a syndicated deal, a deal in which somebody puts together and then come to you and say, hey, I've this property. The property is in this city, it's of this size. We have this great tenant in there or great tenants in there. We're looking for investors. And if you invest this much, you will get this return. And that's the syndication model, right? And as opposed to you going out and buy your own building. Right, and then it's just you and your money and your property. Maybe you'll get together with a few people, a few friends, and family members to buy it together. Right? I generally don't encourage friends to buy real estate together. More often than not, doesn't end up well. But anyway, but obviously it's a viable option to, use your funds to buy your own property, or to use your funds to invest in a syndicated deal involving a medical office building, right? In that case, it's purely passive. You don't have to do any work. Somebody, you have a professional team that is managing the deal to ensure the deal is run properly and well, right? So there are different models, but one of the most common models that you will see out there is it's a fixed return model, right? Because of the fact that medical office buildings are so stable, so consistent, they're usually offered in a fixed return model, right? Anywhere from 8% to 12% annual return, right? Usually distributed on a quarterly basis, right? So it's fixed return. So there's no participation in the risk in the deal. In other words, if the deal performs better, you don't get more, right? If the deal performs worse, you don't get less, right? You get what you have been presented with in the investment documents, right? And it can range anywhere from 8% to 12%. Some of you might be very familiar with investing in multifamily, where it's usually a profit share, right? It's 80-20 split or 70-30 split, where the investors get it's the 80%, and the deal sponsors, right? Deal sponsors are the people who lead those deals, right? They're the leader of the deals. They're the ones who put the deals together. So deal sponsor, in the 80-20 split model, the sponsor gets 20% of all the profit that's generated, and the investors get the 80%, right? So some of you might be familiar with this model, right? And say, hey, why is medical office not conducted in such a model? Some of them do. Some of them. So you're going to see a variety of models being made available in the marketplace. So this fixed return model is going to be one of the more common models that you'll see, right? Generally, it has a minimum 3-year commitment. Okay, so you will leave your money in there for 3 years, and then every quarter you'll get a distribution, right? And the annual return from that distribution will be, like I said, anywhere from 8 to 12%, right? And so when the 3 years is up, right? Usually what happens is that the deal sponsor will say, okay, you're 3 years up. Hey, we got another deal. Would you like to roll this investment into this next deal, right? And this next deal, typically will offer at least the same return, if not better, right? Obviously, you don't want to roll into something that doesn't provide, that provides a inferior return than what you're getting now, right? So you can roll it over, or you can get it out and put it in some other deals if you don't like the deal that the sponsors show you to roll into, right? So the investment term, I say minimum 3 years. It can be anywhere from 3 to 5 years. Then you can roll into another deal if offered to you, or if not, you just take the money out, and you then take the money out and put it somewhere else, right? So that's the model that you're going to see most frequently. There may be some deals where you'll see a mixture of a fixed return and the profit share model that I mentioned, right? They may say maybe they need to raise $4 million. They may raise about $3 million with a fixed return and $1 million with the profit share, right? Because they want to be able to include investors who are looking more for a profit share, be able to participate more in the risk of the deal. They get more if there's upside. If they get less if the performance is not as projected, right? So, guys, with that, that's all I have for you, and I am going to put my information up here, and then feel free to ask any questions. Maybe there are a bunch of questions already in the Q&A in the chat. I think Haley's going to help me with those questions. And here's my contact information. If you guys need to contact me after this webinar, if the questions come to mind after tonight, feel free to reach out. I'll be more than happy to talk more with you.
Awesome. And David, feel free to leave your contact information up there on the screen while we go through the Q&A.
Okay.
We've got a couple of questions here from our attendees, but I also have a few of my own questions.
Okay.
In regards to, we'll go through the attendee questions first, just to knock those out. This first one came through whenever you're talking about the triple net lease, expenses or things like that. One of our attendees wants to just confirm, like, roof repair, parking lot ceiling, HVAC repairs, are all of those considered the CAM?
Yes, generally, right? The key word is look at the lease. Look at the lease, because a lot of times we use the word CAM, or common area maintenance, and we say it like there is an industry standard of what's included and what's not included. Mm-hmm. While that is somewhat true, but it's one of the things that I learned is never assume. Look at the lease, because there may be cases where the tenant has such negotiating power, because it's all about balance of power, right? Mm-hmm. If in some situation, maybe the landlord is desperate to put a tenant in, and the tenant therefore has, the upper hand in the negotiation, and they say, I don't want to pay for roof. I don't want to pay for HVAC. It's all you, landlord. If you want me to lease your space, you got to take that, right? And yeah, so but generally, that's correct. Generally, roof, HVAC, plumbing within the space that's occupied by the tenant, electrical that's within that space, and usually like the sprinkler systems that's put in by the tenant. So they're responsible for all of that. Yeah.
Okay, interesting.
One thing also to note is that sometimes some buildings, the HVAC is not specific for one tenant. I hate those. It makes it a little messy, right? So then you got to work with two different tenants to kind of ensure that there's fairness in splitting that up. Yeah, utilities is the same, right? Utilities, ideal case is that each unit has their own meters. Yeah, then that's the perfect scenario. Sometimes that's not the case. If that's not the case, then as a landlord, when you get the lease done, you got to make sure that the language is there to say, hey, you're occupying this many square feet, and you're going to be responsible for this percentage of utilities coming in. Mm-hmm.
Interesting, which actually and I'm glad you added that extra point on at the end there. It's good information. But it kind of leads me into one of the questions that I had. So for medical office buildings, are triple net leases common? Are they the standard or the norm? Are there any advantages to doing it this way? Are there any disadvantages to doing it this way? Kind of give us a bird's eye view there.
Sure, they're common. They're very common, but it's not a given. Because I have seen. Again, this again boils down to the balance of power between the tenant and the landlord, right? Majority of the time, they are triple net leases. I have seen properties where it's actually gross lease. In other words, so I've seen properties where some tenants are on triple net and some tenants are on gross lease. So gross lease is just another word for they just pay a fixed rent and nothing more. Just like renting a house, you pay a rent, and landlord's responsible for fixing everything. So that is less desirable, because then as a landlord, you take on the risk of your expenses going up or down and so on, right? Whereas a triple net lease, as a landlord, you don't have that risk, because, well, if expenses go up, tenant's paying for it. The only time you're going to be paying for it is if there is a vacant unit, right? There's vacancy. Then you as a landlord will be responsible for the vacant unit's share of those expenses. So that's something to be mindful of. Yeah.
Mm-hmm. Interesting. And one last question from one of our attendees here, not directly related to medical office buildings, but I'm sure you have some insight to share here. One of our attendees wants to know, what do you think about getting some of the inns that have been foreclosed on due to COVID and converting them into senior assisted living or substance abuse halfway shelters? Any insight or opinions on that sort of topic?
Was it using hotels to convert?
Yeah, they said inns, but I assume that means kind of
Inns,
like just
okay, yeah.
hotels. Yeah.
Inns, hotels, yeah.
Hotels. Yeah.
Hospitality, yeah. Hospitality type of buildings. So the answer is it depends. Okay, so let's talk about senior assisted living. Now, first of all, I want to mention that I'm by no means an expert in senior assisted living. I've come across a few of them. I've been involved with a few of them. I know a little bit enough. I know enough to be dangerous. Um, so I have what I do know is this: that there's specific requirements by the state. There's building codes required of senior assisted living facilities, right? So there is a so there are two sets of regulations when it comes to, well, first of all, senior assisted living is under state law, right? There are state laws that govern how they're done, what you can and cannot do. From a building perspective, there are two sets of rules, right? One set of rules applies to those that are 17 beds and up, and one set of rules apply to those 18 under 17 beds, right? So under 17 beds are, I think you guys have had a fairly frequent speakers that come on that talk about
Mhm.
that space, right? So there is a set of regulations on that, right? And then for the if we're talking about converting inns or hotels, to senior assisted living, it can be challenging because there are specific items in the building code that the state requires, that conversion may become financially non-viable, right? So, like for example, the fire rating of the walls of the construction material has to be a lot higher than your typical apartment complex, for example. So, quite a lot of the senior assisted living facilities I've seen are using metal studs as opposed to lumber, right?
Mhm.
And that's one thing. And also the drywall that is to be used, right, has to have certain fire rating, because the argument is that, well, this is senior assisted living, right? If in the event of an emergency, these are folks that you can expect them to move like they're teenagers, right?
Mhm.
So the spread of fire has to be controlled in such a way that they will have sufficient time to get out, especially for facilities that has memory care, right? And so I would say that it's not out of the question, but you do need to look into what's required in terms of code compliance for senior assisted living from a building perspective. And then
Mhm.
you just have to do your numbers. If you're getting the building for pennies on a dollar, maybe it still work. Maybe, yeah.
Interesting. That was a good answer. That's a really good point there about the firewalls too. It's not something like your
Yeah.
average person would really think about, but interesting. And I'm glad I asked it because it does kind of lead into my next question, which does focus a little bit more on the medical office side. So, I know like coming from multifamily and kind of moving into this space, how does it compare? Like medical office buildings, are they being overbuilt? Are you seeing a lot of these investments be new buildings, or maybe like value add type of deals where it's an existing building, converting it? Kind of give us some insight there.
Yeah. So, there's certainly there's okay. So when it comes to looking at real estate, right? And you said it, right? You have building new construction, or you buy existing one and add value to it, right? So certainly there's more and more appetite, or rather attention, on medical office buildings. More and more people are looking to, for example, 1031 exchange. You can buy an office building for $3-4 million. There's a lot of people with $3-4 million to 1031 exchange when they sell. I don't know. Maybe they sell a warehouse, or they sell a retail strip center, and they're looking to then 1031 exchange into the next asset, right? So you're getting a lot of that. So from a investor interest perspective, there is over the last 2 years, it's getting a lot more interest. It is still considered a niche market, right? I know I haven't answered your question. I kind of going towards
That's
it.
okay.
Yeah. So from a so just kind of to set the stage, right, for that investor interest, and then from a development perspective, certainly I have seen some spec builds, right, where somebody just throw up a building and hire a broker. Hey, go find me some medical tenants just to put in here. Certainly have seen some of those, but I think a larger portion of that is purpose built. Is more purpose built in the sense of the developer actually having a relationship with a particular service provider and say where is it that you want to expand your operation. Oh, in this general area, and then they specifically built that facility for this particular tenant or this particular set of tenants, right? Usually it's when they do that, it's for a fairly substantial tenant, right? That they are maybe a regional system, regional healthcare system with very stable financial position, and they'll build something for them where this system is going to occupy maybe 60-70% of the building, and then they hire brokers to lease out the rest, right? So we're looking into developing in this model. I don't like just throwing up a building and hope that somebody's gonna go occupy it, because it's a little risky. I'm very risk averse. I guess maybe that's why I'm attracted to medical office buildings. But anyway, yeah. So we're seeing that as well. But from a value add investment perspective, you're going to see more of the people who are either tenant exchange or smaller properties, right? Tenant exchange, or people like us, where we value add. We may buy a property that has nice tenant base, right? It may be 60%, 70% occupied. We're okay with that. We can improve, give it a facelift, and then hire a broker and bring in the other tenants to fill up the remaining space.
Mm-hmm. Nice. Interesting. Good information. So my last question of the night to kind of wrap up the presentation, if you had any last kind of final thoughts or piece of advice for our attendees out there, what would you share with them? If someone's looking to get into this space, someone's looking to advance to the next level, what kind of final piece of advice do you have for our attendees?
Yeah, I have one general piece of advice, which is, obviously all of us are guests here of Quest. And I would imagine most, if not all of us, are clients of Quest. We have accounts with you guys. And so, one of the most powerful things to grow your wealth is, investing with retirement money, right? Deferred taxes or tax-free growth, right? Whether we're talking about Roth or traditional. I think I said it the opposite, but you guys know what I'm talking about. So the point here is that when it comes to investing with funds like that, right? I feel like a fixed return model where medical office, nice, stable, passive, you don't have to lift a finger to do anything, and you get a fixed return of between 8 to 12%. It's almost a perfect vehicle for self-directed accounts. Why? Because for those profit share deals where you're actually getting a profit share, you might be thinking, okay, well, if I were to use cash to invest in those deals, I would actually get a lot of tax benefits from it, because there's losses from depreciation. And so on. If I use retirement money, then that value, that benefit kind of get lost in it. Even though, using your retirement money comes with its inherent set of benefits already, right? So it's not lost; it's just replicated, right? Mm-hmm. So in this case, I think, it's best for me, myself, for example, I use my retirement money, invest in deals like this, and then I use my cash to invest in deals with depreciation losses and so on, right? So then I get the best of both worlds. So that's sort of that's what I would encourage everyone to do.
Awesome, David. I love that you brought that up because we get that argument so often. People are like, well, I don't get my depreciation. That's okay. Still do that investment with your own funds. In addition to that, find more deals to do with your IRA.
Exactly.
And it sounds like this is a great passive option. So to all of our attendees out there, thank you for joining us tonight. If you guys have questions for David or you want to talk to him more personally about these different types of investments, here is his contact information on the screen here. David, thank you so much for joining us tonight. It was great to see you. Hopefully we'll get to see each other here in person soon at some of these upcoming networking events. And thanks for joining us, everyone. Y'all have a great night.
Thanks for having me, Haley. Thank you. Good night.
Awesome. Bye. See ya.